Well, the biggest event of this week was a non-event, the decision by OPEC not to put a floor under oil prices. We saw from the very dramatic, sharp falls that followed that the market really did need OPEC to put a floor under it, with the knowledge now that OPEC isn't going to be trying to stabilize supply for a while. That changes the picture in quite a lot of important ways. Perhaps the most important impact is on the dollar, as we're showing you here. There is a very clear inverse relationship between oil and the dollar. A cheap oil price means a stronger dollar. A stronger dollar has further knock-on effects, perhaps most intriguingly in terms of the balance of power between developed and emerging markets. So we're showing you here. The last time you had a sustained rise in the dollar over a number of years overlapped with truly awful performance for emerging markets. That was in the late 90s. You saw a series of currency crises in emerging markets. Now, they're less prone to a currency crisis now than they were, but certain emerging markets, particularly the oil producers, still look very exposed. A stronger dollar will help attract funds to the US rather than to emerging markets. This is certainly something very important to look out for. Another important knock-on effect is on inflation expectations. As we can show you here, the expectations in the US derived from the bond market for inflation over the next 10 years have now dipped below 1.8% for the first time in 3 years. That's the kind of level which in the past has prompted the Fed to resort to new QE bond purchases. It certainly implies that the risk of rate rises to choke off inflation could be put that much further into the future. It's plainly, in the short term, very good news for the stock market. Now, in the next week, we do have a lot of event risk to look forward to. There is the Swiss referendum on whether the Swiss National Bank should be forced to buy more gold over the weekend. It's expected to fail. Plainly, if it passed, that would have a very interesting effect. We have a meeting from various central banks, primarily the European Central Bank. Everybody now seems to expect that they will resort to QE bond purchase of their own, but that's a very difficult political issue. What Mario Draghi says about that could be very important. He needs to continue to stoke up the expectations that QE will happen, or there will be a market response. And then, of course, there's lots of macroeconomic data since the first week of the month, culminating with US payrolls on Friday. But finally, I think the most important point to make is the logical point. Cheaper oil is ultimately good for the economy and good for most stocks. Even if you actually saw the fall in oil companies actually counteracting the very strong gains for some consumer companies in the immediate reaction to OPEC, this continues to push the risks towards an outright melt-up or bubble in the stock market before this rally is done. We continue to live in interesting times.